Okay, let's take another look at what's happening in the markets this morning. And generally, we're seeing some positive performance. The S&P and TSX are up. The Nasdaq's a little bit weaker. We are still waiting another inflation read in the U.S. this week. And speaking of inflation, there are big hopes in the market that because we've seen some improvements there, that interest rate cuts are on the horizon. But there are lingering worries about the what if. What if inflation remains sticky? If you're trying to position your portfolio to hedge that risk. Our next guest has been thinking a lot about this theme. Mike Archibald is Vice President Portfolio Manager at AGF Investments. He joins us here in studio. How you doing?
I'm great. Thanks for having me.
Well, thanks for coming in. And I think that there is a hope, whether it's consumers or investors, that we will continue to see an improvement in inflation. But you've been thinking about what if we don't see the kinds of improvements people are hoping for?
Yeah, look, I think inflation has moved down, obviously, from the high levels that we saw last year, and I think that's likely to continue a little bit here. I'm not sure we're going to get as close to 2% as everyone thinks we are, and part of the reason for that is what we've seen in commodity prices recently, and those have really exploded to the upside, as you noted earlier. Gold prices broken out to all-time high, copper's moved nicely through 4, and energy's up around 80. So all those things are inflationary as you start to move out, call it 3 to 6 months from now. The other thing that I think is important is manufacturing data looks like it's bottomed and is starting to turn higher. And there's tends to be a fairly high correlation between, manufacturing data moving up and commodity prices following along suit. And so I think what is important here is that the character of the market may shift a little bit, and we've seen that so far in the month of March. You've seen commodity prices do quite well. You've seen Toronto actually outperform other markets in North America, largely because financials have been working and because commodity prices have been working. So to the extent that that continues, I think you could see a little bit more outperformance from Canada, and we would be what we would call this reflationary environment where growth remains relatively elevated, inflation stops really going down, and maybe actually starts to tick up as we get to the back end of 2024.
Okay, so even the possibility of a push up in prices, and nobody knows, but you're positioning around that. So the hedge is through pure TSX exposure or exposure to some of the commodities or commodity-related stocks?
Absolutely. There's lots of things you can do, and I think, as I said, the character of the market is changing right now, and technology has been a very big leader in the market, and I'm not suggesting that those stocks are going to sell off a lot, but you may start to see other leadership take hold, and I think we're starting to see the early signs of that. Financials in particular, you could see banks start to do a little bit better as rates get cut once or twice here, and you start to see capital flow a little bit more, and then, of course, commodities are a great hedge to that, and I think that's really the message that you're seeing out of gold and energy of late.
Performance right now, yeah, it's a lot of moving parts with those movements, but that is certainly a fair one to consider. When we talk about financials, sometimes here we'll talk about the homegrown banks. We had a conversation with a guest earlier about some of the money center banks in the United States. You're thinking about those names, I'm sure, but you're also thinking about other names in financials as perhaps an investable idea.
Absolutely. On the bank front, we certainly own exposure there. I think the credit profile of the banks is going to start to look better as you move through the back half of this year, and rate cuts are going to be beneficial for them, provided that they can keep good control over their expenses. Names that we like here, though, are asset managers. I think this is the perfect time in the market for asset managers. Stock markets have done quite well. I still forecast them to do fairly well in the back half of this year as well. So asset values are moving up. They're earning more fees on that, so their sales continue to move higher. And if rate cuts do start to happen, you get a double-edged sword on that, which is you'll start to see more activity in the marketplace. Trading will go up. Investment banking activity should start to improve. And then secondly, you're going to see money move out of GICs and more into equity-like products or fixed income products where asset managers earn a better margin. So Raymond James is a name that we've talked about. We have exposure to that name. $1.4 trillion in assets in the U.S. Really like it. Looks like it's got about 15% growth expectations for this year on the earnings line. I think the trajectory for that is probably higher. And again, as I said, trade's only around 13 times earning. It's a pretty cheap stock. And if you think that rates are going to come down, this is a good way to play it both from the asset management side and from the investment banking side.
So just to be clear, though, rates coming down, but you talked about that reflation theme. So explain the reflation aspect of a name like that.
Yeah, it's less about the reflation on particularly with respect to Raymond James. It's more about the asset markets moving up, and if the investment markets continue to do well, stock markets continue to go up, asset values move higher, and obviously then the earnings profile would follow suit.
Okay, another stock that you wanted to flag today is FirstService, a property management company. How does that fit into this sort of macro theme you're watching?
Yeah, so this is a good long-term compounding name that we've recommended here on the show before. Gives you access to the U.S. market. Obviously, 90% of their revenues come from the U.S. I think as housing starts to continue to do better down there, they're the largest manager of residential communities in the U.S. Done very well. They're a good long-term compounding name. Have grown sales at around 15% compounded over the last 5 years. So fits really well into sort of the slow growth theme of, I guess, of the marketplace here. And so, there's two verticals that these guys operate in. Obviously, property management is one of them. We quite like that. It's a very steady part of their business. And then on the FirstService brands, which is more restoration, fire services, flooding, as you get more volatility in weather patterns over time, we continue to think that this is a good business. So very disciplined company. They have a great balance sheet. There's lots of optionality for them to continue to do M&A. We look at their margin profile right now and see it moving higher, over the coming 12 to 24 months.
I don't want to stretch too far, but is there an argument to be made, going back to that reflation theme, that if inflation is sticky and interest rates have to stay at more normal levels to address that, you hear this conversation all the time about higher rates complicating new building of housing. So if you've already got housing stock or a stake in that market, and the market is somewhat tight, I would imagine that is beneficial to those who are already in that real estate sector?
Very much so for them. And their pricing on their contracts has been moving up with inflation. And so you've seen that in the last couple of quarters. They've seen better than expected pricing increases around 3%. And they're winning new business still. So for those reasons as well, yeah, it fits that reflation theme.
Okay, so bottom line is financials and commodities, and to a certain extent, companies that are tied to housing. These are some of the ways that people can think about if they are bearish on the fight against inflation going as well as some are hoping. Those are some of the ways to hedge the portfolio.
Absolutely. And to be clear, I'm not necessarily bearish on inflation. I don't think it's going to start to move back higher a lot, but I just think that it may settle out in a level that's a little bit higher than where central banks want it.
Yeah, nobody knows, right? This is just sort of prudent planning, just based on the what if, I guess.
Absolutely, and the hedge is obviously that the commodities have done quite well, and I think they're under-owned. And as commodity prices move up, you're going to start to see cash flow and earnings estimates move higher, and we know how that cycle works. And so you should start to see, I think, a little bit more interest coming into to the commodities and hopefully the financials as well. Okay.